Welcome. If you're running a small business, managing a team, or just trying to keep your books in order, you probably spend hours on work that feels like it shouldn't need to exist. Invoices that need coding by hand, bank statements that need matching by hand, expense reports that need categorizing by hand, email threads that need summarizing, meetings that need scheduling around 3 calendars, reports that could be auto-generated but aren't. I'm here to tell you that's changing fast, but before we dive in, let's be honest about what's happening, because there's a lot of hype. So in this module, we're going to show you what AI is actually doing in accounting and administration work right now, not the marketing version, the real version. By the end of this series, you're going to have hands-on skills with the tools that are genuinely saving time for thousands of businesses. You'll know which ones fit your situation, and you'll know exactly what not to expect. Here's the clearest signal that AI in accounting isn't a future thing. It's a now thing. The biggest accounting firms in the world have stopped testing and started deploying. Look at the investment these firms are making. KPMG, $2 billion over 5 years, targeting $12 billion in new AI-enabled revenue. Deloitte, $1 billion plus, and they built an entire AI platform called Zora in partnership with NVIDIA. PwC put $1 billion into generative AI. EY is building 150 autonomous AI agents. And here's the kicker. Starting summer 2026, KPMG is removing human involvement from entire parts of the audit process. That's not a pilot, that's production. Let me translate what that actually means. KPMG's Clara platform now reviews 100% of a client's transactions, instead of auditors hand-checking a sample. PwC's GL.ai, it handles journal entries and general ledger review, work that used to require a senior accountant to do manually. Deloitte's Zora AI processes invoices, matches them to purchase orders, and flags discrepancies without human intervention. But here's the thing that tells you this is real, not hype. These firms cut their graduate hiring. A lot. KPMG cut their graduate hiring by 29%, Deloitte cut by 18%, EY cut by 11%, PwC cut by 6%. That's not symbolic. That's a business decision. These firms literally need fewer entry-level people doing invoice processing, document review, and basic reconciliation, because AI is doing that work now. The role that used to be a training ground for junior accountants, partially automated away. That signals the automation is real enough to affect hiring decisions at the world's biggest accounting firms. So what exactly is AI good at in accounting and administration? Here's the honest list. First, transaction categorization and GL coding. The AI learns from your historical patterns and automatically codes new transactions. It flags the outliers for you to review. Second, invoice processing and matching. Extract the data from PDFs automatically. Match to purchase orders. Flag when something doesn't line up. Third, bank reconciliation. Auto-match transactions across your accounts. Flag anything that doesn't reconcile. Fourth, document summarization. The AI reads contracts, invoices, receipts, summarizes the key points, and flags anomalies. Fifth, expense categorization. Auto-code your expenses, flag anything that violates your company policy. Sixth, meeting summarization and task assignment. The system transcribes your meeting, summarizes it, and auto-assigns action items. And seventh, email and inbox triage. Categorize incoming messages, draft responses, highlight urgent items. Notice the pattern? These are all repetitive, pattern-based, high-volume tasks, thousands of transactions, hundreds of emails, dozens of receipts. The kind of work where doing it manually consumes entire weeks, but the rules are straightforward. The shift that's happening is from doing to reviewing. A bookkeeper used to code 400 transactions a day by hand. Now they run AI over those same 400 transactions and review the results. They accept 185 as correct, flag 8 based on unusual vendor patterns, and manually recode 7. Time spent, a fraction of the original. But here's what the vendor demos don't show you. AI fails. A lot. And in accounting, failure has teeth. Best AI model still fails roughly 1 in 5 accounting tasks. A model that's good at transaction classification can fail badly at reconciliation. They're not the same risk profile. Almost half the time saved by AI is spent correcting outputs. Think about that. You're not saving 5 hours, you're saving maybe 2. Here's the kicker. 56% of CEOs achieved zero financial return from AI. Only 7% of CFOs report strong impact from AI, despite 60% of their teams piloting it. That gap between the pilots and the results, that's the honesty you need to have going in. There's a specific risk in accounting that makes this worse than other fields. It's called hallucinations. That's when an AI confidently generates numbers or facts that are completely fabricated. In customer service, a hallucination is annoying. In accounting, it compounds. Watch what happens. AI generates a liability of $250,000. It flows into the variance report, then the forecast, flows into board materials, and finally investor communications. By the time someone catches it, it's everywhere. There was a high-profile case at one of the Big Four where an AI audit review hallucinated numbers. The total looked right, but the breakdown was wrong by 34%. That error would have failed the audit. The AI had generated plausible-sounding numbers that were completely made up. The responsibility still sits with the human. You have to own the work, check the output, and apply judgment instead of copy-pasting. So if AI is this powerful, why isn't every accounting firm using it? The answer isn't, the AI isn't good enough. It's messier than that. Barrier number 1, fragmented, disconnected systems. Your data is spread across QuickBooks, NetSuite, Salesforce, manual spreadsheets. AI can't see the full picture. Barrier 2, data quality. Inconsistent chart of accounts, missing vendor master data. Garbage in, garbage out. Barrier 3, fear of errors. 35% of finance professionals cite fear of hallucinations. The gap between finance and IT tells you something. The people closest to the numbers are the most skeptical. Barrier 4, tool sprawl. Switching between platforms erases time saved. Notice what's not on that list. The AI model isn't smart enough. The real blockers are organizational. They're about data, systems, and trust. The firms winning with AI aren't using it for magic. They're solving one problem well. One painful, repetitive task that consumes hours every week. They clean the data going into that task. They pick one tool that integrates with what they already have. They give ownership to one person who tracks whether it's actually saving time. And they measure in real numbers, not improved efficiency. Hours saved per month, days shaved off the close cycle, errors reduced. So what tools are we actually going to cover in this module? These aren't 5 separate stories, they're layers. Most small businesses start with one of the core platforms, QuickBooks for accounting, Copilot for admin, because they're cheap and they integrate with what you already have. Then you add a specialized tool when you hit a specific pain point. And at the top, you've got the emerging tools, agentic AI and continuous accounting. These are coming but not yet mainstream. The key, start at the bottom. Don't try to do everything at once. At this point, you might be thinking, if AI is handling all these tasks, what am I doing? Fair question. The data is clear. The US Bureau of Labor Statistics projects employment of accountants to grow 5%, faster than the average for all jobs. The profession isn't shrinking, it's shifting. Here's what's changing. You stop doing the work, you start reviewing AI work, catching errors, and applying judgment where the AI can't. And then you spend your freed up time on the stuff that actually matters. Understanding why a number moved and building strategy. Firms report a 30 to 45% increase in employee engagement when repetitive entry disappears, and 20 to 30% lower turnover. Better client relationships. The Big Four aren't laying people off because of AI, they're retraining them. Shifting roles from manual verification to validating AI processing. Same headcount, higher value work. So here's what I'm going to tell you before we dive into the tool specifics. Don't try to AI your whole accounting. Pick one thing. Here's the successful pattern for implementing AI in your accounting workflow. Step 1. Identify one painful, repetitive task. Something that takes 5+ hours a week. Same rules every time, not judgment calls. A low-risk task to start with, not your tax positions. Step 2. Clean the data going in. Fix categorization inconsistencies. Fill in missing vendor or account info. Make sure the source data is trustworthy. Step 3. Pick one tool that integrates with what you have. Don't add a 6th platform. Prioritize integration over feature count. Step 4. Give ownership to one person. Someone tracks results, identifies blockers, drives daily usage. Step 5. Measure in real numbers. Hours saved per month. Days shaved off deadlines. Error rate reduction. Actual dollars saved. The firms that succeed do this. KPMG's Clara isn't used everywhere at once. It's rolled out workflow by workflow. Small examples that work. Invoice processing. Saves 10 plus hours a week. Low risk. Expense categorization. Saves 5 hours a week. Immediate accuracy win. Bank reconciliation. Saves 8 hours a month. Clear before and after. Email triage and drafting. Saves 3 to 5 hours a week. Feels immediately fast. The wins compound. Once you see, hey, this actually saved me Friday afternoon, you're more confident trying the next task. In our last episode of this module, we're going to talk about what's next. Because AI in accounting isn't stopping. The next frontier is agentic AI, systems that don't wait for you to ask them to do something. They monitor your financial data, detect when something's off, investigate the problem, and draft a corrective entry, all without waiting for a human to kick off the process. Everything you'll learn in this module is an AI assistant. It waits for you to ask. The next wave is an agent. It acts on its own. Is that coming soon? KPMG said summer 2026, so it's already here for the big firms. It's coming for everyone else, but that's for later. For now, your job is to understand what's actually working, where the pitfalls are, and how to pick one small win to start with. In episodes 2 and 3, we're going to dive deep into QuickBooks Online and Intuit Assist, the platform most small businesses already use, where you can see real impact in a day. In episodes 4 and 5, we're going to show you Microsoft Copilot, the tool that handles email, scheduling, expense tracking, and the admin busy work that eats your calendar. In episode 6, we're going to talk about specialized tools, Ramp for spend management, Bill for invoice processing, and others for specific pain points. And in episode 7, we're going to look at what's coming and what you should be preparing for now. By the end of this, you're not going to be confused about AI in accounting. You're going to know exactly what to try, how to avoid the common mistakes, and why it works. Let's get started and dive into the future together. See you in the next session to keep learning about AI in accounting.